Arabic session running in parallel. So, good morning, everyone, and welcome to our fourth session of Chamber Talk. I'm Sultan Hatoum from Abu Dhabi Chamber of Commerce and Industry, and I'm very glad to be with you today and throughout the whole program. I would like to thank you all for finding the time to join us on this important webinar, where Yusuf Hassan from KPMG will be discussing a topic of mass concern: accounting and disclosure implications of COVID-19. What companies should be doing. Please note that you can also attend an alternative Arabic session that will be running in parallel to this one with instant translation on the link that just shared in the chat box. So, the pandemic has brought with it considerable uncertainty to businesses as they are now dealing with lost revenue, supply chain disruptions, discontinuation of activities, increased volatility in the value of financial instruments, and many other uncertainties at all levels of operations, which basically have left them vulnerable. So what does this have to do with your financial statements? How it can be related to proper bookkeeping and IFRS reporting? And why companies should worry from an accounting perspective? One simple answer: unprecedented times and situations implies unprecedented accounting, especially that the economic impacts of the pandemic mean that investors and stakeholders need high quality of financial information more than ever. As they always say, accounts tell the story, but which story it tells depends on how you account for impacts of COVID-related events before and after your reporting periods. And here comes Yusuf's role in trying to address some of the key impacts of IFRS reporters and the accounting requirements that should be considered when assessing the financial impact of COVID-19 in the preparation of financial statements for the annual or interim reporting periods ending 2020. With the depth and horizon of the pandemic still unclear and hard to predict, challenges will accompany the preparation of financial statements. There will be issues to consider for this year's reporting as well as in future years. The list can go very long, starting from going concern to impairment assessments, fair value measurements, insurance recoveries, contracts provisions, restructuring plans, breach of loan covenants, liquidity risk management, and many other accounting estimates and financial statements disclosure requirements. All these implications vary by industry. So, for example, it won't be surprising to see more non-performing loans in the financial sector, more of going concern issues in the tourism and hospitality sector, and so on and so forth. In conclusion, when reporting in uncertain times, it is important to provide users of the financial statements with appropriate insights into the risks and uncertainties facing an entity and the judgments that have been made in preparing financial information. So for guidance on all of the above, I'm pleased to introduce our speaker for the day, Yusuf Hassan. Yusuf is a partner and heads the Accounting Advisory Services Division of KPMG in the UAE. Yusuf also heads the technical department of the KPMG Middle East South Asia region. He is a specialized trainer and has won the 2013 ICAEW Award for Excellence in Training of Finance Professionals and is also KPMG's permanent representative at the ADTF ADAS Technical Committee. He heads the Technical Committee Forum of the UAE Accounts and Auditors Association and in the process of signing an MOU with the organization to support them in their initiative to get 100 Emiratis to qualify for the ACA-based UAE qualification. Before I pass it to Yusuf, as always, we'd love to hear from you during the session. If you have a question for our speaker, please feel free to send it through the Q&A tab at the right bottom corner of your screen. Yusuf will be answering these questions at the last 15 minutes of the session. Yusuf, it's all yours.
Thank you very much, Sultan. Assalamu alaikum wa rahmatullahi wa barakatuh. Good day to everybody. These are interesting times we live in. I remember in 2008, after the global financial crisis, having a similar conversation about the impact of the global financial crisis with people. And the interesting thing that time, when having that conversation, was I spoke mostly to banks, spoke mostly to people regarding financial instruments, about share price, etc. This time, I'm speaking to everybody. Clients have come to us with numerous concerns about the financial reporting implications. There isn't a new accounting standard to account for COVID-19. We do have the ISB giving some guidance on IFRS 9. We do have the standard setter providing some guidance on rent concessions. But there isn't a new accounting standard. Transactions that we'll now start experiencing tend to be a little different, not things we are familiar with. We're starting to see restructuring provisions, redundancy provisions, massive impairment provisions, rent concessions. These are new transactions that we are experiencing. IFRS has always traditionally dealt with these things, dealt with these types of transactions. However, for many of us and our clients, these are unfamiliar territories we had to apply practically. Now, look, we're all aware of COVID-19 and what the implications are. Sultan has kindly introduced the topic and said, look, the impact of the pandemic will certainly impact financial statements. How much, when, how do I disclose this? These are all considerations we have to consider. You know, a typical easy approach to do this is probably look at my balance sheet and income statement, go through it line by line and try to see how each of those line items will be impacted by COVID. What are the implications? If you do that kind of exercise, I promise you, you will see that the implications on the financial statements and the note disclosure will be far-reaching and pervasive. What I'm going to be doing today is go through some of those challenges, some of those changes. We're not going to go through all of those changes. The approach I'm going to have is I'm going to present you with a whole host of slides focusing on assets. We are going to be looking at the balance sheet. We start with the balance sheet, very important. And what are the impacts on the values on the balance sheet? Obviously, that's linked to the business. And what are the key impacts on the business would be the driving factor, which translates into the balance sheet. And obviously, the accounting must reflect the changes in the business. Secondly, we'll keep to the balance sheet. We'll look at liabilities. What we find in the context of COVID-19, many new provisions, obligations tend to be created. The question with regard to these obligations is, firstly, do we have an obligation? Secondly, when should we recognize them? And thirdly, how much? Maybe the fourth question pertaining to that would be, how do I disclose it? But the important technical accounting questions would be, do I have an obligation and when do I recognize it? But look, there are going to be significant impacts on the balance sheet, assets, liabilities. I will explain these to you. I will explain to you how these are triggered off, what management should do, and how they should be disclosed. These slides will be made available to you afterwards, so you will have access to the slides. I will not be going through each line item on every slide in the interest of time. However, I will be covering all the key points. For banks, we want to talk about financial instruments impacts. I mean, as Sultan earlier mentioned, provisions for banks in this time will be extremely volatile. People, will my debtors pay? Will they be able to pay? What if they're approaching me for a restructuring? A lot of my old models were historical-based models. IFRS 9 is asking me to look at future-looking information or future economic scenarios. I can't predict these. During the lockdown, my clients asked for deference of payments or deferral of their payments. Is this a significant increase in credit risk? People are approaching me for restructuring. How will this impact my balance? What we're seeing, or what we're going to talk about, is some of the considerations banks have to have as well, because the provisions will significantly impact their balance sheet. The fifth issue, lease contracts. A lot of entities, due to the closures of malls, the lockdown, etc., have approached their landlords, or the landlords have approached them to change terms in the lease contracts. And we call these rent concessions. How should we be doing the accounting for these rent concessions? We'll briefly discuss those as well. If government provides assistance, support, how should this government assistance be accounted for? if government is providing an interest-free loan or general sort of assistance or subsidization, these existed in IS 20, but it's a standard we needed to probably dust the covers off or dust off the dust of those standards, because these were standards that are old and we haven't had much of an opportunity to apply them in practice. What are the key impacts on financial statements from an auditor perspective? Will we retain our going concern applicability? How would things be applied for us? And one of the bigger questions we had on our quarterly audits is COVID-19 an adjusting or non-adjusting event? We covered that briefly as well. And finally, just to have a more relevant perspective on reporting and what should happen at June 30th, September 30th, before the annual financial statements, we want to talk briefly on how you should be doing some reporting in your interim financials. So all in all, we've got a very, very full session, but what we're trying to cover here are the accounting implications of this, what you should be thinking about, how you should react, and how you should be telling your users about those changes. Let's start off with the business. The objective of accounting is to allow or to give a measurement of how the business is performing. The true reflection of the impact of COVID-19 will come through the financial statements. The financial statements is a measure. So Tan mentioned earlier that the way the effects of the COVID, the implications of this will come through the financial statements. Did I have a good year? Did I have a bad year? This will all be reflected through the accounting treatments. I mean, in times of crisis, people tend to look at the accounting standards and say, no, the accounting standards are causing the issue. It's the other way around. The accounting standards should tend to reflect the implications around us. So if you are seeing volatility in the financial statements, that volatility is expected because of the volatile situation. Some of the impact we see on KPIs. See, essentially your financial statements will have an impact. This is an event. Financial statements are historic in some matters, but forward-looking in some measurement matters. What we're seeing and when in the market and on the KPIs is many industries have lower revenues and higher costs. Lower revenues, lower demand, etc. Higher costs, redundancy costs, fixed costs not being absorbed, etc. We also have lower gross profit, lower margins, unavoidable costs. I mean, while your properties remain vacant or your commercial property, you're still being forced to pay rent on those properties, whereas you don't have the opportunity to service that. Liabilities, your liabilities still remain intact, but due to the change in your balance sheet, etc., your ratios and your covenants could be impacted, your debt equity ratio, etc. CapEx. Now, companies who are incurring CapEx, there's various issues. I mean, in some cases, they may be withholding CapEx, but the bigger question we tend to get in the market is pertaining to, is my contract work in progress impaired or not impaired? Not just the contract work in progress, generally, there's a massive, massive risk of all my assets, my non-financial assets, as well as my financial assets being impaired. Return on investment is reduced. Free cash flows as an impact or a combination of all these elements will be impacted. So essentially, if you are a manager, CFO, finance director, COVID-19 will impact a number of your KPIs. Revenue would be down and all analytics related to revenue would be impacted. EBITDA is a very, very important consideration. It's not an IFRS concept. A non-IFRS measure, but that would be something that would be immensely impacted. CapEx would probably go down. However, return on assets would also be impacted, return on investment, and cash flow to equity ratios. The point we're making, if you as a client or a customer looks at your balance sheet and probably look through the implications of all these matters, what we're asking, or what I would hope you would do, is anticipate the accounting issues that could arise and work through them Anticipate them. Get the data now before your annual financial statements. Everyone is aware that it is an uncertain time. Estimations will be at its peak. Fair values would be more subjective, greater reliance on unobservable inputs. Therefore, a level of estimation judgments would be higher than in prior years. I've got now a few slides on various industries and their impacts. These are in the news. You should be hearing about this. And this is probably, less of the accounting impact. But as I said before, the 2008 crisis seemed to have a limited impact on certain industries. For example, banking, financial assets, and to some degree, real estate. However, the impact of COVID-19 has impacted airlines, tourism, oil price. Significant oil and oil-related industries have been severely impacted by this. The insurance industry, due to escalating medical costs and the underwriting of medical risk, were also severely impacted by COVID-19. Media and entertainment, very, very different context and world in which they apply. Mobility services, during the lockdown, many entities who provide mobility services or supply chain services were severely impacted by that. Real estate, very, very interesting situation. There was constant real estate challenges, and the pandemic will probably exaggerate some of those elements. In fact, people are talking about the movement away from office space due to the work from home that has been successful. In consumer and retail, we've also seen many challenges. While some areas of retail might have gone up, we've also seen areas of retail that have been highly challenged during COVID. But that's about business. And look, the objective of accounting is to capture the impacts and the application on the business. The objective of accounting is to reflect these challenges in the most honest way. In terms of discussions with our clients, I've seen two different kind of philosophies. Sometimes a client would like to be very, very conservative and say that, look, COVID-19 has happened, the market has expected this, and perhaps we should be booking and taking as much of an impairment loss or being as prudent as possible in 2020. And you get on the other end of the spectrum, people are saying, look, I hope this is just a temporary issue. We don't want to be too conservative. Now, when I say being conservative or aggressive, I'm not saying being over prudent or over aggressive. I'm saying all this within the realms of the standards, not structuring things to be conservative or aggressive, because accounting is not about being conservative or aggressive. It's about presenting information in the correct manner. But within the judgments and estimations, the view or the philosophy behind being conservative, if I take as much of my losses this year, maybe in 2021, 2022, I will have a better income statement and a better reflection of things. Whereas if I take an aggressive view or a less conservative view, in future years, I stand a risk of possible future impairment. There are various possibilities within that, but that's been some of the thoughts and conversations we've had with clients on this matter. Let's talk with assets. Let's start with assets. And the question we're going to ask is, let's look at your balance sheet. Are your assets that you have at the right value? And look, what we're going to be looking at is non-financial assets. What are non-financial assets? Your property, plant and equipment, your investment property measured at cost, your intangible assets. Are they impaired? Are they impaired? When I'm saying impaired, do we have to write them down and book an expense? Do we have to accelerate the depreciation on these assets? We'll discuss that. We then talk about some revenue cycle assets. And what are revenue cycle assets? It's inventory and your construction work in progress. These assets, how would they be impacted? Should they be impaired? What are the triggers for that? And what should you be telling your users about that? And a critical element in this time of uncertainty is fair value determination. What is fair value? How much are things actually worth? Because that's the key determinant of how much you write down. You need to be able to write down to a recoverable amount, which is higher of fair value, less cost to sell minus value in use. What is this fair value? Can we determine it in these uncertain times? Can I rely on market prices? How good is that information? So let's start with this topic on impairment of non-financial assets. What you will find in 2020, certainly there is a trigger for impairment. Your auditors would typically request you to do a test of impairment on majority of your assets. Typically you don't have to test for impairment unless there are triggers of impairment. So what we're saying about the COVID-19 pandemic is it essentially triggers off the test. What are we saying when we're saying test for impairment? You need to calculate recoverable amount quite simplistically. And what is recoverable amount? It's the higher of value in use and fair value less cost to sell. Now, when you've been asked to do that calculation, you need to be ready. You need to make sure you have your cash generating units, your assets identified. You need to have your cash flows ready, your discount rates ready. Now, having all those things ready is one matter. What we've experienced in our discussions with clients is that these cash flows might be challenged. These cash flows and our budgets that we prepare to support these cash flows are now not going to be the same. The economic outlook that we expected in 2020 is not the same. How will this impact 2021, 22, 23 and the foreseeable future? So those cash flows may need to be reassessed in light of the current circumstances. And look, the bottom line is there will be a risk of impairment. Also have a look at your discount rate. I mean, there's two elements to a calculation of recoverable amount. It's cash flows and discount rates. Are your discount rates correct? The fourth point, which I think we need to have been doing all along, but may be now more relevant than ever, is re-looking at our useful life and residual value of assets. Is our useful life the same? Are we going to get the same degree of use? Are we going to change plans? Are we going to be moving towards online platforms, for example, and may not be using our office space as much, and maybe the useful life is shortened? The second point, or the second thing, is what management should do. You'll see throughout these slides, I deal with them in three aspects. Key points is what is the issue, what management should do, and then the third element, which is what you should be telling the users of financial statements. What should management do? Management should look at the indicators of impairment, decide on your cash generating units, at what level should you be testing, make sure your budgets, your cash flow projections are all relevant and have the best available data you have. Update your valuations, re-look at your weighted average cost of capital, re-look at your discount rates, have a conversation, have these conversations with your engineers, your facilities people about how you see the assets' useful life. In some cases, you may choose to prolong a useful life on your assets. What do you tell the market? Because of these uncertainties and these challenges to your asset values, because they are highly assumption based, you need to provide information to your users, your shareholders, your lenders, etc., about the degree of uncertainty, how you've calculated those numbers and the assumptions you have made regarding impairment. What about revenue cycle assets? These are trade receivables, and we will be covering the bank's loan exposures after this. But we're talking about the impairment of trade receivables. Are your debtors going to pay you in time? Now, I'm sure most of you have been doing some kind of IFRS 9 calculation of your provisions on trade receivables. Are the future expectations changing? Are the dimensions changing that cause you to book a higher expected loss? In the good old days, we used to have an incurred loss model which waited for the trigger of default. The new requirement of impairment requires you to consider forward-looking factors. And now, how do we bring in these forward-looking factors into my provision calculation? Secondly, with inventories. Are the inventories at the right value? All the stock that I have, because of constrained trading conditions, are they at the right value? Will I be able to recover the cost of these assets? And these are important questions that we need to ask. Everyone states in their financial statements inventory is carried at the lower of cost or net realizable value, and probably leave it in our accounting policy. This may be the year where you have to look at your net realizable value and potentially write it down. Also, other aspects, contract costs. When we talk of contract costs, we're talking of construction, work in progress, things that we have constructed for others. We need to look at them. Are these contract costs still recoverable? Can we still amortize them, and are they not impaired? Management typically will have to do this. What will they have to do? They will have to apply IFRS 9 on this. You have to make much more significant estimations. You have to look at the amortization period, etc., to be able to do that. And like the other sections, the disclosures, you have to tell the users of financial statements. See, the idea behind the disclosures is because you will be making lots of judgments and estimates. By disclosing those estimates and judgments, a user of financial statements will be able to see how you have looked at your business versus a competitor. The third point I'd like to cover is fair value determination. Now, in respect of any impairment calculation, net realizable value calculation, or different values to test impairment, we need to know fair value. Now, in current economic uncertain times, people are suspicious about fair value. Is the quoted market price correct? Is that the right price? Can I use this price? Should I be using this price? Is the market active? Isn't this a distress price? The problem that we have is a lot of people want to depart from a quoted market price or a market price that is available. The typical example or excuse or repose we hear to that argument is that the market isn't correct now. What we should remember is that fair value is at a point in time, and we should be accounting for fair value at a specific point in time. It's time specific, so we have to make sure we take into account conditions that exist. These current conditions are not temporary or will impact the valuation. If the current market is distressed and there's enough pricing information in the market, we should not be ignoring this. So I think what management must do regarding fair valuation is, look, use as much market available information there is. However, there is an expectation that not all information will be in the market. There will be unobservable inputs. And this would force you to use a level 3 kind of fair value. And just quickly, there are hierarchies of fair value. Level 1 is a quoted market price that is unadjusted. Level 2 is derived mostly from market prices. And level 3 has a large amount of unobservable inputs, which are not from the market, which is more of a management valuation or a determination of fair value. Now, the idea behind fair value is to use as much market information as possible, not to ignore the market information if there is, and take a management biased valuation. But because you're going to be having a lot more subjective valuation of your investment property, of your assets, various other matters, it's very, very important to tell the users how you get that number and how you derive that number. So that's a little bit of the asset side. And let me conclude on the asset side. I think, look, the biggest risk on the asset side is impairment and getting the right number. Do I have an impairment is the first question you'll ask. And if I do, how much should I impair? And within that, what should I disclose? How should I disclose? What are the sensitivities around those impairment calculations? Now let's move on to liabilities. And the question that we're asking here, are you recognizing all your liabilities? Now, why would we ask this question? Generally, in IS 37, you only recognize a liability when you have a contractual or legal obligation. However, what has occurred, or what we've learned from COVID-19, is you may have situations where new liabilities arise. Onerous contracts are one example. What's an onerous contract? Is when you are contracted to do something, but the unexpected costs of meeting the contract or the costs of meeting the contract exceed the benefits you are going to derive from that contract. And this is the only instance in IFRS or in terms of provisioning when you are asked to provide for future operating losses. It's only when you have an onerous contract. So this is one element which people should look at is, are my agreements, are these contractual agreements which I can't get out of, these commitments that I made to my customers, are they imposing on me new liabilities because I will not be able to fulfill them? The second part of the question is, despite the onerous contracts, what about other provisions? What if I'm introducing staff redundancies? What if I'm doing restructuring? What if there is a newspaper announcement that I am going to have a massive redundancy plan or something of that sort? The question with regards to these liabilities is, firstly, do I have an obligation? If I make a statement in the newspaper, am I obliged to create a provision? Secondly, when does the provision arise? How much? And finally, what should I disclose in my financial statements? So look, what we're going to be talking about is unavoidable liabilities and loss-making contracts. And this would be an instance where we have to provide new provisions, employee benefits. What about the changes to the employee situation? What about the end of service settlement that is early? What about termination benefits? How do I account for them? The guidance existed in the standards. However, the application of this guidance is now being tested currently. And then finally, we'll talk about restructuring provisions briefly. Let's start off with the unavoidable liability and the loss-making contract. So in terms of this, and we might have entered into many contracts with our customers, promises, provided vouchers, provided gift vouchers, for example, which we may not be able to redeem, or various other elements of entering into agreements which we may not be able to fulfill in the current context. What we think management should do is look around for these. You don't want to get into a situation where at year end, you're ordered to say, please pick up this provision because you have an onerous contract. What you need to do at the project level or at the contract level, look at your projection of cost versus benefits, look at termination clauses, and see whether you have onerous contracts that you have to look after. And you need to obviously provide disclosure on that. In terms of employee benefits, we've seen, or we continue to see, not just in the UAE, across the world, various changes to the remuneration policies that we're offering employees. We see restructuring plans, we see different assumptions, different changes in benefits, etc. The question on these is, be aware of these. There isn't a one-size-fits-all kind of solution. You need to know about the type of change and the accounting implications that it will have. The issue on this, or the technical accounting issue that you need to be aware of, is what is the nature of the employee benefit adjustment? How should I correctly measure it, and how should I disclose it? What we've seen in practice is a variety of benefits that are being triggered in this time. In most cases, it tends to be a simple benefit, a salary reduction, etc. However, we are seeing termination benefits, restructuring provisions, and some post-employment benefits kicking in as well. Let's talk about restructuring provisions. Now, the question about restructuring provisions is, many companies would say, hey, we intend to lay off so many staff because of the situation. The question we are asking is, do you have an obligation? Now, why is that question relevant? Let's take an example. I make an announcement in June. Let's say we make it on June 16th. The question is, at 30th June, do I have to recognize a liability for this restructuring in my interim financial statements, or my 30th June financial statements? What the standards say is that you only recognize a provision when there is a formal plan of the restructuring and you've raised a valid expectation in those affected that the plan will be impacted. So it's not just a plan, there is a massive and between that, is that you've created an expectation. If you have discretionary kind of plans which you can turn around, change, or you have not created an expectation, there is no restructuring provisions. So what we want management to do, if there is a discussion about a restructuring provision, think about it. Think about what are the consequences, what are the trigger events, have we closed the loop on creating an obligation, which period the obligation should be recognized, and how should we recognize those provisions. So that's on the liability side. So we've covered assets and liabilities, and this tends to apply to most companies, etc. The section I'd like to cover now is particularly related to banks. And for banks, the biggest impact for them would be expected credit losses. As it's expected credit losses, by definition, is asking the banks to anticipate how much of their receivables will not be recovered in full. How much of credit losses will be incurred? Now, this is a very, very interesting situation because banks would have created very, very complex models to try and predict losses in terms of their books. They're different industry sectors according to different customers, retail, wholesale, etc. But in this context of an uncertain market, how would you apply future economic scenarios? No one would have expected or anticipated the events of 2020. So how should I measure my financial instruments? So a few thoughts. We're going to be covering expected credit losses, significant increase in credit risk, which is very, very important consideration for banks, because with banks, you have three levels you divide your exposures into stage 1, stage 2, and stage 3. Stage 1 being your good book, stage 2 being the book that has gone into sort of a stage 2 or a lower or a higher credit risk profile, and then the third bucket being default. And there is a massive change in provisioning between bucket 1, stage 1, and stage 2. And that trigger between moving from bucket 1 to bucket 2 is a significant increase in credit risk. The question that we'll ask now is there a significant increase in credit risk? Do I now have to provide as a bank, because people have missed a few payments or there has been liquidity challenges, do I now have to provide at a higher rate? In other words, is there a significant increase in credit risk? The third point is fair value determination as well. We've covered this related to assets in non-financial assets, but we're now going to look at fair value determination in the context of shares, bonds, etc. Various other elements. How do we do the accounting? Hedge accounting. I've had hedges. I'm looking at forecast future transactions. Are these going to be impacted by COVID? Do I still have a hedging relationship? Do I need to rebalance my hedges? And fifthly, is I may have to renegotiate the terms of my borrowings. How do I renegotiate the liabilities? Whereas 1, 2, 3, 4, we're talking about the financial asset side. The fifth one talks about renegotiations. The renegotiation would apply both sides. It applies to a financial asset and the financial liability side. How would that be accounted for is an important consideration. Now, this slide's got a lot of wording on it, but I think the messaging that we want to have on this is just the concept. From a bank's perspective, you have to consider future economic scenarios in measuring your provisions. And you need to be using unbiased, probability-weighted amounts, using reasonable and supportable information based on historical data, past events, current conditions, and forecast of future economic conditions. And the wording in the standard says that it's available without undue cost and effort at reporting date. And the point we're trying to say now is This obtaining of this information, my historical models may not be predictive as they used to be. They were based on history. This is an unprecedented event which changes the way we've looked at history. So we may have to look at things in a very, very different way. We may have to cut things out in a very, very different way. Are your models going to be relevant is the big question. Have a look at those, have a look at other elements, maybe look at management judgment or management overrides may be more common going forward. Also, the way to manage increased uncertainty is to provide additional disclosure. The reason you're doing that is there is an acknowledgement that the information is going to be sparse. There's different uncertain information with limited predictive value, but you still need to prepare your financial statements, and auditors will expect you to do your financial statements. Your users will demand some kind of reporting in this context. Bridge the uncertainty by providing adequate, detailed disclosure around judgments and estimations so that people can understand your perspective of the future. On this point of significant increase in credit risk, the question is, do I move from a bank, my exposures or my level of provisions from stage 1 to stage 2? Obviously, this doesn't impact the default items, but is it moving into the third bucket? What we're saying here is perhaps due to the COVID-19, a lot more times we would be able to rebut the 30 days past due presumption. And obviously, similar to before, we would be able to we need to provide disclosure on our rebuttals. The ISB has provided some guidance on this, and all they're doing and all they're saying is, look, maybe the historical data or the assumptions that were calculated may need to be changed. We need to look at, and I think I'm drawing your attention to point 5, you should be giving consideration for the effect of COVID-19 in your model, and in point 6, changes in economic conditions have to be reflected in your models, in your weightings. And what they also acknowledging for banks is there might be a lot more model overlays. In terms of fair value measurement of your instruments, we've covered this earlier. Be careful about your asset portfolios, your equity portfolios, anything that requires a fair value, your derivatives, etc. In valuation of your derivatives, be aware that the credit or the debit adjustment may become relevant now in the current context. Be aware of the quoted market prices in the market, whether they are an active market, can I use it? And also try, I think the expectation is where the fair value in an observable market is not forthcoming, we'd have to be using more unobservable information. As we said earlier, hedge accounting, there could be changes to hedge transactions, especially those related to forecast transactions or forward transactions. Unlike IAS 39, there's no suspension of hedge accounting. However, management must have a look at whether the hedges that they have continue to remain effective or there needs to be a rebalancing of the portfolio. Changes to liabilities is an important slide. If you are renegotiating your liabilities, there are two possibilities. Either this is seen as a substantial modification or a non-substantial modification. Why is that important from an accounting perspective? If it is seen as a substantial modification, you're recognizing a new loan. And this could have a massive impact on your profit on the date of negotiation because it will entail de-recognizing the old liability and recognizing a new one at fair value, and there could be a gain or loss. If it's a non-substantial modification, then there isn't so much of a day one impact. And therefore, it's important to consider whether a modification is substantial or not substantial. And from a liability perspective, there is a quantitative assessment where you see whether the net present value has changed by 10% or more. Let's get on to another few contracts. I'm aware of time and I want to create maybe 5 or 10 minutes at the end for general questions. I want to cover 2 or 3 more topics. Let's talk quickly about leasing contracts. We've seen a lot of our retail clients have rent concessions, and that's been an important consideration where they may have been given rental holidays, deferment of rent payments, etc. Let's talk briefly about the accounting for those. And there also would be changes in lease estimates regarding lease term, etc. So a lot of estimations were made during IFRS 16 compliance on your lease term, your discount rate, your renewal options, etc. Those estimates may be challenged or changed now based on current circumstances. But let's start with rent concessions. If someone has given me a rent concession, if I'm a retailer and they say, oh, don't pay rent for 6 months, or we will defer your rental payment for a while, the typical accounting treatment for a lease modification, for a rent concession, if it was not included in the original contract, would be a lease modification. If it was in the existing contract, it's treated as a variable rent and accounted for going forward. However, there is a big risk if it's a lease modification. You have to revalue the liability, revalue the asset, and present value those cash flows at a very, very different discount rate. And that could cause an issue. The standard setter has provided a relief on that and says that during COVID, if you have a rental concession, you have a choice, a practical expedient not to treat it as a lease modification. And this is something that people need to consider. Changes in lease estimates, as I said, there could be changes in lease term, an option to extend, not to extend, terminate early. Have a look at your lease contracts, have a conversation with facilities people, have a discussion with people who are dealing with the asset side, because these could have accounting implications. What about government assistance? If government is going to support you, how do you account for the support? So I think the first question for government grant is to determine the nature. Is it government assistance? Is it something that is a grant related to income? Is it a grant related to assets? And how these would impact you. Various government interventions across the world, they have different impacts. I mean, there's different ways that government is supporting people in respect of COVID-19. And subsequent to that, we need to know about the presentation of those government grants. What are the key questions or the key impacts on financial statements from an audit perspective or from a reporting perspective? I think there's 2 points I'd like to talk about. One is COVID-19 an adjusting event or a non-adjusting event? Now, this was a prevalent question for quarterly financial reporting. And, you know, the test for this is, do I make adjustments to the valuations of my 31st December due to COVID when I'm reporting my 2019 results in March? And the consensus about this is COVID-19 itself did not exist probably as a problem at 31st December. So in most instances, it would be a non-adjusting event. But careful consideration should be had on this. The bigger impact and the bigger implication is around going concern. So in terms of going concern, there's 2 issues. One, going concern applicability will always be an adjusting event. And there is an underlying assumption in financial reporting that the entity is going to continue as a going concern. However, COVID-19 might be causing some challenges on whether my going concern is applicable. Do I have enough cash? Will my debt covenants be called in? Will I be able to continue for the foreseeable future? Do material uncertainties exist in my business? So these are important considerations. Keep these in mind. Be aware that there might be significantly more disclosure. Finally, what's the impact on my interim financial statements? So you may be required to have interim financial statements. Generally, interim financial statements are condensed sets of financial statements. But because of the COVID-19, users may be expecting a lot more detail in your financial statements. The objective of interim financial statements is to focus on changes since your last annual financial statements, but also bring users up to speed with new events that have happened. Now, obviously, these new events have had significant impact on your business. It's a very, very unpredictable event that has occurred in COVID that has caused changes to judgments, assumptions, impairments, etc., going concern applicability. So what we would say on interim financial statements, a lot more challenges, a lot more measurements, a lot more impairment, and a lot more information should be provided in interim financial statements than was previously done. Impairment assessments that exist and trigger points that have existed require testing at this point, and maybe much more impairments would be recognized and disclosed. And let me close up with a summary. Let's see the recap of points. As I said, business will be significantly impacted. Financial statements will reflect those impacts. Assets will have to be valued. Impairment is likely, and the disclosure becomes critical. Onerous contract provisions are expected. Restructuring and employee terminations need to be accounted for, and the timing and measurement is essential. All aspects of IFRS 9 provisions for banks will be severely impacted. Lease concessions, be aware of them, they will have accounting consequences. Government assistance may need to be accounted for. If there's any government intervention, brush up on IS 20, there are going to be situations. Going concern applicability needs to be constantly looked at and considered. Interim financial statements will reflect these uncertainties. And that, from my side, concludes the presentation. We're now ready to take any questions that you may have. I am aware that we're not leaving enough time, but we did start 5 to 7 minutes late. If there are any questions that remain unanswered, we will endeavor to get back to you or to the group in totality. So, Tom, over to you. I'm going to take a sip of water.
Thank you, Yusuf. Very informative, actually, and I would say as well detailed. As mentioned earlier, this is a topic of mass concern. Everyone will be reporting at the interim and year end, and hopefully that all the info that you've provided today was helpful to the audience. We've received a lot of questions. I'm gonna start with the last topic that you've ended with on government grants. So we have here 3 questions from Mahmoud, Sirnath, and Mazhar, all relating to government grants. Some of them you've already have probably covered, but I'm gonna state all at once and you can answer. So Mazhar is saying if you can shed some light on the impairment of non-financial assets funded through government grant recorded as deferred income. And Mahmoud is asking how to treat government grants. Is it other income? And another question as well on the government grants is that most of the time you don't get a confirmation on government support in writing. So is it only confirmed when the money hits your bank account?
Right. Let me start with the last one. I think there's a great questions on government grants. Let me start with, I'll answer all of them in a package. So let's start with the recognition of a government grant. Government grants usually have conditions attached to them. When do you recognize a government grant? When you comply with those conditions. Then there's 2 kinds of grants. There's a grant related to income or a grant related to an asset. So a grant related to an asset is where they say, please build this asset. We will subsidize this asset construction for you. The asset's going to cost 500. We will give you 100. That is a grant related to an asset. Or a grant related to incomes, they say, look, you are not going to earn enough income, or you're going to have a large amount of expenses this year. If you do the following, we will give you 100 to settle your expenses. When do you recognize it? You recognize it when you have complied with the conditions to get it. Now, a grant related to an asset, you have 2 accounting positions. You can either write it off against the asset. So if you got 500 of capex and the government has given you 100, you can write the asset at 400, and net off the government grant on day 1. Alternatively, you keep the asset at 500 and keep a deferred income balance going on that balance, which means as you depreciate the 500, you will be releasing the deferred income of 100. If there is an impairment of the asset at 500, then to balance off the government grant accounting, you would typically release more of the deferred income in proportion. However, the government asset may still be impaired if the government grant isn't 100% of that. You understand it? So I hope I've answered that questions for you on the government grant. So I've spoke about the recognition, I've spoken about an impairment of the asset, and given you two considerations around the presentation of the government. Okay, Sultan, next question.
Yeah, so Ramesh wanted to know if there are any specific guidelines for the insurance sector.
Fantastic question. So insurance sector, look, there isn't currently an insurance accounting standard in play yet. IFRS 17 is going to be effective going forward for 2021 with a comparative year, right? And what would happen, I mean, there would be additional provisions which would be coming under, depending whether you are short-term or long-term insurance consequences. What for short-term insurers, I think what would tend to happen is you're going to be using an unearned premium kind of approach on short-term insurance. What would happen is you'd probably have to adjust your premiums. For longer-term insurance, this is going to affect your IFRS 17 liability. Currently, at 31st December 2020, no impact. However, going forward, the implications of this will more impact the amount of the liability, the quantum of that, and obviously, insurers are expected to adjust their premiums and their pricing. So technically, it's going to affect measurement more than anything, rather than specific matters on IFRS 17.
Thanks for clarifying this. A question from Binoy about what would be the treatment of COVID-19 expenses if the company is eligible to claim under force majeure, but not settled and stay in balance sheet as receivable at the time of 2020 audit?
So you've got expenses which you have booked, right? And you want to claim it back from the government. Now the question is that government right? Does it exist? Right? So you have incurred the expense. If it's claimable, there's a few more questions there. I mean, government is not going to directly settle that obligation for you. It's just giving you a subsidy on that. Look, you'd have to look at detail on that. My initial feeling is that the expense and the reimbursement are separate events that cannot be offset. And the recognition of the asset depends on meeting of the conditions for the government grant. So you could have the expense, which you incur in 1 year, but only get compensation for that in another year. You could potentially have the expense without having the receivable in a year. It's very, very possible if you haven't met the requirement for the recognition of the corresponding assets. However, this will depend on facts and circumstances. What I can say is it's very unlikely to have a direct offsetting impact if that's what you're looking for, to try and conceal the COVID-19 expense, because it's very unlikely for the government to take a direct situation or pay your employees directly or something. Right.
Okay. We have here the same question, like almost same question by Leila and Ali. And I believe you've already, Yusuf, tackled this, but if you have other remarks that you would like to add on the extension of payments during COVID-19, whether it be with banks or with, B2B.
Right. So let's talk about that. So in terms of liabilities, let's say I'm owing a bank money. I go to the bank and say to them, I can't pay you this money. Can you defer the terms? I owed it to you in 3 years, make this a 5-year loan, etc. Change the rate or something of that sort. So in that, it's a renegotiation of a liability. That can be a situation with the bank. It can be with a creditor, for stationery or any supplier for that matter, right? The question that the IFRS asks you to look at is this modification substantial or not substantial? If it is substantial, you then have a new liability, which means discount the new cash flows going forward at the current market rate and de-recognize the old one. So you debit the old liability, credit the new liability at the new cash flows and the new discount rate, and the difference would go to profit or loss. It's an income statement entry. So to decide whether a modification is substantial, there's a quantitative matter. You've got to say that the cash flows have changed by more than 10%, or there's qualitative. So typically in practice, we look at the quantitative first, and then we look at the nature. Are we borrowing from the same person? Are the terms changing? How much of the qualitative matters are done? That's for a substantial modification. If it's not substantial, what we'd have to do is keep your original effective interest rate that is built into the arrangement on the loan and project the future cash flows on that rate. So what I'm saying, if it's a new loan, you reprice to a new rate and you have a gain or loss. Whereas if it's an existing loan, you don't have the re-recognition and the writing of the old one and creation of the new one. You sort of have a cumulative accounting going forward.
Okay, I believe this interlinks with the question from Rizwan Yusuf on loans in specific. So, is it mandatory to move to stage 3 for any loan in case it is classified as non-performing loan?
Yeah. See, good question. See, if it's a non-performing loan and the person has already gone into default, then it's very unlikely that he's going to change now in a COVID-19 situation. COVID-19 has made matters more adverse. What we're seeing in terms of the guidance is more a movement between stage 1 and stage 2, right? And maybe also remodeling matters. If a person is in default and is unlikely to repay, then you're probably in a recovery mode in any event. And I don't think COVID-19 would change any of that. You know, if companies that were experiencing financial difficulty already, you know, and if there wasn't a prospect of support, I doubt during the current crisis, which would have impacted them, would be in a better off position at all. So for me, level 3 remains level 3. Your original definitions of level 3 or default remain, or non-performing remain the same. I think where we have some flexibility is in re-looking at our models for future economic scenarios and re-looking at migration between stage 1.
We're already running a bit late. We started like a couple of minutes late, but I mean, we're receiving a lot of questions. And if you don't mind, Yusuf, if you can extend this for another 2-3 minutes so I can take 3 or 4 more questions, because we have a lot of interesting questions. I have here I have here one which is very, very interesting, and I had it in mind as well as a question from my end. It's mainly around, this is from Hazim. So as more provisions, 1 second, I've lost it. So okay, I've lost Hazim's question, but I have it in mind because I had it myself. So with all the with the current situation, with many non-performing loans and all of those issues, and increase in provisions will have effect on the financial positions, which will lead to adverse impacts on the bank facilities. So people will be defaulting on their payments. This will by default lead to a drop in their credit score at the Hedge Credit Bureau. So what's your opinion on the way forward, next steps, when things get back to normal and people want to lend again? So how that will be going? So banks will look at the credit score by default. So
yeah. So look, I think this is something that has a pervasive impact. I'll answer the question from an accounting perspective, and from the economic side, I won't be able to give a prediction or something like that, because if I knew, we'd know what would be happening in the future. So look, credit scores will be impacted, right? Typically because of challenges, and credit scores have a number of factors. A lot of companies or banks specifically will be reliant on those Etihad Credit Bureau scores, and will have migration patterns saying that if your credit score drops by 3 points, you will move into stage 2. What we're saying practically will happen or could happen is that the bank applies some kind of management overlay and say, look here, my rule is 3 notches down in credit score will move you normally to stage 2. However, due to the current circumstance, I know you as a customer. These are my governance processes. I want approval not to move you to stage 2. I want to rebut my current process and procedure. So that's what I think may happen. But you see, if a bank doesn't do that, then you could be at risk of being aggressive rather than conservative by not booking enough provision, a sufficient provision, which means you're setting yourself up for risk in future. So from a bank's perspective, it's a very tricky balance on how you apply your judgments and estimates. See, the provisioning is an estimate, and an estimate is not accurate. Nobody knows how much is not going to be collected, but your estimates have to be using the best information possible. And what we're seeing or saying now is that maybe management overlay could support something in the absence of data. All right. So how is it going to work? Is it going to be more provisions? Yes. But it's going to be also more judgment-based provisioning, according to what I'm seeing from the ISP. They're saying moving away from a mechanical approach to the provision. Yeah?
Okay, last 2 questions, and very quickly, Yusuf. So Hans is asking, being compliant with COVID-19 regulations is a challenge. Do you expect an increase in regulations?
Look, yeah. You would, typically you would. I mean, generally, when you have these situations, what we're seeing globally and internationally is there are specific conditions related to government support. There will be more government scrutiny. In terms of that, you're typically going to expect more compliance. People will spend money on different things, eligibility of programs. So, look, whether there'd be more regulations, that depends on what needs to be regulated. But from an accounting perspective, I don't think any of the COVID-related issues are presenting new accounting situations. So these things are there. Impairment is there. In some cases, from an IFRS perspective, the standard setter felt a need to intervene. For example, in the rent concessions discussion and in the IFRS 9 discussion on expected losses. But I don't think there's going to be new transactions from an IFRS perspective. Other regulations, I'm not in a position to comment. I'm on the accounting side. But my view is you'd expect compliance burdens to increase, and that would be linked to government assistance and support.
Okay, thank you. Last question from Muhammad. So long-term commercial contract, like 5 years, impacted due to temporary rental discount, 3 months rent discounts. So he's asking about the impact on IFRS 16 implications as well fair value. This will be considered as a trigger for impairment testing?
Good question. So look, this is actually a good thing. You are the lessee. I'm presuming you are the lessee here. So somebody has told, or you've got a long-term commercial contract, and you giving a rent discount, or you are taking. Let's look at it from both perspectives. So I've got a commercial property contract. If I'm the lessee and somebody has given me 3 months of rent discount, this is a good thing for me. It's helping me. The question I will ask from an accounting perspective, is this a modification or not? If it's a modification, I recalculate my liability and my right of use asset. Now, my right of use asset already includes the liability, so typically that already builds in the issue. Then my impairment of my right of use, that's the store. Let's assume it's a store. That right of use asset will have to be tested generally in terms of my rules of impairment. So that right of use could be part of a bigger cash generating unit, or I could look at it individually. And that would be an independent test of impairment. But typically, a reduction on rent is supposed to ease your burden of impairment. So it should be less impaired. And a right of use asset, which you have a liability for, you don't double count. You're already accounting for the cash outflow in the liability, so you don't have to double whammy yourself by booking the ROU. It's only when the ROU is genuinely impaired. In terms of a lesser perspective, look, the lesser perspective, there is no such relief. the lessor will have to account for a rent concession over the period of the lease. You cannot take an immediate loss and say, this is a COVID-19 year, dead year, let me take the loss. The lessor has to treat it like a normal, over the period of the lease.
Thank you, Yusuf. I believe this could last for another hour or so. People, so we have like 300 attendees on the session, and
Right.
A lot of questions are still coming through. So for all those who we couldn't get the question to Yusuf, Yusuf has promised he's gonna look into it and he'll get back to you later. So that's good. Thanks, Yusuf, for this. And thanks for your time. If you have any closing notes before I close from our end.
No, thank you for your participation. I think look, my objective today was to leave you with some awareness that, look, the year end is 6 months away, but prepare yourself. There are going to be a number of issues. I think the easy way to do it is look over your balance sheet, income statement, and, do a little bit of a red, yellow, green to test whether each individual line item of your financial statements will have an impact or something that you need to prepare for going forward. I think, look at that. I mean, red means big problem, and that could be impairment, valuation, provisioning.
Yeah.
Small problem would be revenue or something of that sort, or, have a look at maybe your valuation of your stock security. Look, I think, and just on a disclaimer, I think, look, when we giving and answering and responding to questions, I mean, there must be much more significant information provided. I've given responses in a very, very general sense. If you're going to do we had access to all the information, that would be different, and you need to look at independent accounting advice on those matters. All right.
Thanks again, Yusuf. I'm receiving like a couple of questions from Zulfikar, which I don't think they're probably relevant to today's session. But anyway, you're going to have the chance to look at them, and if they are, I'm certain you'll get a response to him because he's asking on rental basically.
Okay.
Thanks again for your time. This is I would like to mention again our survey. This is probably the last chance to audience, our members, and the private sector in Abu Dhabi fill the survey so we can hear your voice and get good insights of it. I hope you find this session insightful, as I did, and many others probably do. So next week, we're gonna have on Sunday a topic with Deloitte on crisis management, returning back to business, and what are some of the key considerations that companies should think. And on Tuesday with EY on education as an enabler of economic activity in the context of COVID-19. Until then, stay safe and have a good weekend ahead. Have a good day.